Hello, everyone. Uh, Today, I just want us to go through South African income tax. I've been having some question when it comes to the calculation of SA income tax, especially where they ask you to calculate or to provide an income tax note. Income tax note can look a little bit short, but there are some supporting calculations that need to be availed for that particular presentation. So I'm just going to use a short exercise just to explain some of the basic concepts, and hopefully this will clarify some of the important facts. My name is Sylvester. You know, these are my contact details. This is the question that I compiled, and I just want us to go through it, and hopefully this question will highlight the most important facts. Firstly, I want us to just analyze the information. We need to know the fact that we are, this is the name of the business, this is our business, LTD, Sylvester LTD, and then our year end is 31st of December 2019. Okay. And again, as you can see from the additional information, we have what you call the profit before tax, and that amount for profit before tax is how much? Is 3,774,320. The profit before tax includes profit on sale of land. For how much? For 187,000. So this can also be referred to as a capital profit. Remember, the capital profit is subject to the capital gain tax. So the inclusion rate is 80% currently. So at the moment, I can see that we've got a capital profit which we made that will affect our taxable income. This land that was sold was originally purchased for how much? It was originally bought for 870 during the year 2018, meaning we bought this land during 2018. This is our previous year. And this will affect us by the time when we deal with the changes or the movement in temporary differences. Remember, the movement in temporary differences will also affect our current tax calculation. So we need to make sure that we know how to account that. At the same time, we have got an after-tax foreign income of 77,000, which was also included in the profit before tax. This foreign income is taxed in, let's say, from other countries. So at the end of the day, we need to make sure that we include the foreign income inclusive of what? Of tax in our profit for the year. So the foreign tax that we paid on that is how much? Is 11,000. Okay. So we must bear in mind that this foreign tax income is net of what? Of tax. So we need to adjust at the end of the day. We're going to adjust our profit before tax because the profit before tax must include the foreign income before tax. So here we foresee that 11,000 is going to be added back to 77,000 to be included in the taxable income for the year before we can deal with those other adjustments. But for now, we're just analyzing the information. We also received a local dividend of how much? 6,750. Remember, local dividends when it comes to taxation, they are normally exempt from what? From the income tax. And again, here, the information has been given to us saying the dividends is exempt as per income tax act. We also have the depreciation on the vehicle. So in other words, we do have depreciation on the vehicle for an amount of 963,600, which was taken into consideration by the time when we were calculating the profit before tax. And SARS also allowed us an allowance according to the section 11E amounted to how much? To 990,000. So this information will affect us by the time when we calculate the deferred tax liability or deferred tax asset. So as I said, for now, we're just analyzing the carrying value and the tax base on the above mentioned vehicle amounted to, meaning this is the carrying value is 3,484,800, and the tax base based on the SARS information is how much? 2,750,000 respectively. And then currently our normal income tax rate is how many percent? Is 28%, and the capital gain inclusion rate is how much? Is 80%. So from this information, we are asked to draft income tax notes in the financial statements for the year ended 31st of December 2019. So it means that our main aim here is to calculate the income tax note. So before we can go and adhere ourselves on the note, we need to have the supporting calculations for this. So at the moment, pause a bit, make sure that you are familiar with the information. You can even take the screenshot of this, and then so that when I switch over to the next slide, you can be able to follow. I hope at the moment everything makes sense. The first thing that I'm gonna do here, I'm gonna deal with the deferred tax calculation. Remember the preferred method of deferred tax calculation, we are advised to use the statement of financial position approach, and those who did audit accounting like me, we used to call it balance sheet approach. So the balance sheet approach here is going to be used to calculate the deferred tax. Okay. Firstly, we need to make sure that we deal with the figures at the beginning of the year, meaning the end of the previous period, and then at the same time, we need to deal with the figures at the end of the current year. So firstly, we need to focus at the beginning of the period. So if you can check from the information here, we have been given the carrying value at the end of this period. And at the same time, we have been given the depreciation for the period. So if we can add back those depreciations on the carrying values, we will be able to know how much was the carrying value at the beginning of the year, meaning at the end of the previous year. So firstly, we need to deal with the carrying value at the beginning of the year or at the end of the previous year, okay? Now, firstly, we've got land. If you can check here, we've got land which we bought, and that land was bought for 1,870,000. So, as you know, land is not depreciable. So the carrying value, because there was no revaluation during the period. So the cost was 1,870, which means it's the same as the carrying value, and the tax base is also 1,870,000. And if you get the difference, and the difference is 0, and it means we are not going to have any deferred tax, any temporary difference or deferred tax at the moment, because the costs, the carrying value is the same as what? As the tax value. Remember, we also had vehicle, and that vehicle again, they gave us the carrying value at the end of the period. Remember, they can ask you to calculate those carrying values. Remember, you can depreciate using the different methods at the end of the day. So when they only give you the costs, it means they will give you the depreciation policy. So that policy must be used to calculate the carrying value at the end of this period. But currently, we've been given the carrying value at the end of 2019. So for me to know the carrying value at the beginning of 2019 or at the end of 2018, we need to add back depreciation. As you can see here, according to the information here, the carrying value of the vehicle was 384, and I had to add back its depreciation so that I can get its carrying value. Okay, the same applies to the tax base. They gave us the tax base at the end of the period. I have to add back the tax allowance, meaning the tax allowance is like, in a way, depreciation according to SARS. So these are the figures which I have. So if you say 3, let me find the highlighter. If you say 3,484,800 plus 9,636,600, you get what? This amount, 4,448,400. The same applies to the tax base. If you add 2,750,000 plus 990, you get what? 3,740,000. You see? So here, remember, we are still at the beginning of the year. We try to work back. Now, if you take the difference between the carrying value of this vehicle and the tax base, you will get a temporary difference of how much? Of 708,400. And remember, this temporary difference will give us the deferred tax liability because our carrying value is more than our tax base. So this difference will give us the deferred tax of how much? Of 198,352. The reason why I put brackets because as you can see here on top, I said the assets, can you see? The assets are without brackets and the liabilities are within the bracket. So meaning if I put brackets, it means we've got a deferred tax liability here. And this is going to have an effect on our income tax for the year. So this is how we calculated. We just took the temporary difference, which is this one, and we had to multiply it by what? 28%. So 100% of this temporary difference was included here because this is not land, is not a capital asset at the end of the day. So that's why we include the 100% of the temporary difference. Because if, let's say, for example, this was the land and the land was revalued, so that revaluation amount, we were supposed to only include 80% of that amount of money under temporary difference, which will at the same time affect what? The way we calculate what? Effect tax. Yeah. After doing that, we need to make sure that we find the total of the temporary difference is 0 plus 708,400. And at the same time, we get what? 0 plus 198, we get 19852. So meaning at the end of the previous year, the deferred tax liability is how much? Is 198,352, which has got a corresponding temporary difference of how much? 708,400. Yes, you can still find the totals here. You can still add the 2 and then add this one, and you get the total. So if you take those totals and you minus them, you're still going to find what? The 708. But what is important for me at the moment is how to deal with the temporary difference, which led us to have the deferred tax liability. After dealing with that, we need to go and focus on our current year, which is the 31st of December 2019. And if you can check from the given information there, we did sell. So obviously, I'm still going to have land, but then that land has been sold. So I'm not going to have anything when it comes to carrying value. There's no tax base as we sold that asset during the previous year. Okay. But when it comes to the vehicles, we did not sell any vehicle. But here we are going to deal with the carrying values at the end of this period. So the carrying values were given as follows. As you can see here, we have got 3,484,800 and then tax base of how much? 2,750. Remember, again, here is just a short explanation of this. I'm just trying to explain the concept. They can ask you to calculate your own carrying values and even the tax base, but more information is going to be given to you. Again, the same thing that we did on top there, the difference between the carrying value and the tax base gave us what? A temporary difference of what? Of 734,800. And again, the 100% of this temporary difference is included here. So we're going to have a deferred tax of how much? Of 205,744. This is how we calculate 3,4,800 times 28%. And again, like we did under the previous year, we need to find the total temporary difference, and at the same time, we need to find the deferred tax liability at the end of the period. I hope so far everything makes sense. So after doing this, we need to go and focus on the total of what? Of our temporary difference. As you can see that from the previous period, the temporary difference was 708, and now we've got what? 734,800. So there's a movement in between. So we're going to say 734,800 minus 708,400. The same applies to what? Deferred tax liability. There was a movement. We're going to say minus 205,744 minus 198. So we are going to get what we call the movement through profit and loss. Remember, this will affect profit and loss at the end of the day. It will affect the income tax calculation. But let's say, for example, we had the revaluation on the land and building. That will be a movement in temporary difference through other comprehensive income. Meaning I was supposed to have another one here saying movement in temporary difference through OCI. But because I only dealt with the information that affects the profit and loss, that's why I say the movement through profit and loss. And I'm going to go and say 26400. What did I do? I set 734 minus 708, and we got what? 26400. And at the same time, yes, we must do the same thing here, and we just have to say 205,744 minus 198,352. You will get 7392. Or again, if you take this 26400 and multiply it by 28%, you will still get the same amount of money. So it's up to you at the end of the day. Okay, this is how to calculate deferred tax using the balance sheet approach or using the statement of financial position. So I hope everyone is following at the moment. Yes. The next step is to make sure that we calculate the next requirement, which is going to be the calculation of what? The calculation of, let me just quickly do this. We need to make sure that we check any possibility of what? Of adjusting profit before tax. Remember, when you go through the information, sometimes you find that there were adjustments which were supposed to be part of the profit before tax. And those adjustments need to be made before we can calculate our current tax. Okay. So firstly, as you can see here, we've got the profit before tax. I'm going to put it here as profit before. That is the first thing that I need. The profit before tax is given to us as 377,420. But when we went through the information, there was some information which was supposed to be part of the profit before tax, but it was not taken into account. If we remember very well, we had the foreign income tax, and that foreign income tax was included in the profit before tax, but it was after tax. So it was supposed to be before tax. That's why now I must add the income tax which was deducted, of which is only 11,000. Okay, because the amount after tax has already been included. Okay, so we need the amount before tax. That's why I add back income tax, and my adjusted profit before tax is how much? 3,785. Any other possible adjustment that we can find in the future, you can find that maybe they've got accrued expenses. You know what we learned from our accounting one. So we've got accrued expenses, we can have prepaid expenses which were not taken into account, any errors. So it means you need to have that basic accounting so that you can be able to know whether you need to adjust the profit or not, the profit before tax or not. Immediately after adjusting, we can start calculating our current tax. So we firstly need the profit before tax. Remember, is a new one. This is the adjusted one. This is the adjusted one. So can you see what you have here? You need to put it here. Normally, when we mark this, if this is wrong and then you put it there, so we just normally mark the principal at the end of the day. So that's why let's say this thing is wrong, normally we give you a method mark for this. Okay. From the profit before tax, remember the profit before tax is the same as the accounting profit. This is what our accountant calculated according to our incomes and expenses. But SARS doesn't use same systems as us. Sometimes you can find that there are other expenses which were used as part of the calculation of this profit before tax, but according to SARS, they are not taxable or they are not deducted. So we need to make sure that those items which are not taxable, they are deducted, and the ones which are not deductible, deductible, they are added back. So firstly, I'm going to check any non-taxable item, meaning I will need to take them out. Firstly, we have got profit on sale of land. A profit on sale of land is like a capital profit. Okay? And then remember, we can only include 80% of that profit in our profit before, in our taxable income. So that's why we must go and take out only 20%. Why? Because already the whole profit has been included in the profit before tax, but the inclusion rate was only supposed to be how much? Only the 80%. So at the moment, we need to make sure that we make adjustment for that. Okay. So we need to make sure that we deduct that 20%. Okay. Okay. Just paused, but let me continue. Now, so I was just saying, we need to make sure that, remember already the profit on the sale of land has been included according to the information. So we were supposed to include only 80% according to the inclusion rate. So I'm gonna go and take out what? 20%. Hopefully that makes sense. Yeah. Secondly, the foreign income that we had before, remember we had 77,000 and the other one was 11. This 11,000 is the tax. So we need to make sure that we have the amount before tax. The whole amount before tax need to be adjusted. Again, this is not taxable. This is not a South African income, so it's not going to be taxed in South Africa. So that's why we're taking it out. We're not going to tax this because it has been taxed from a foreign country. And then we also have dividends received. Dividends received are exempt. Again, as per the information, they are exempt. So again, you must take them out. They are not taxable. Okay. So again, we need to check. We need to know which items are non-taxable and which items are taxable. And thereafter, we need to add any non-deductible. In other words, we have got some items which SARS says you cannot deduct for income tax purposes. Remember, if something is deductible, it means we end up paying less tax. So there are things like fines, penalties, those things are against the public interest. So we cannot just make sure, cannot just deduct them. So SARS prohibit us from deducting those items. So things like, for example, here we've got the capital loss, the penalties, fines, legal fees, donations, depreciation on office buildings, impairment on goodwill, interest expenses. Again, you need to go and refer back to your standards and make sure that you know which items are what? Deductible for those. So remember, the legal fees sometimes can be deductible and sometimes they're not deductible. That's why sometimes they tell us whether something legal fees are deductible or not. The same applies to donations. They can sometimes they're deductible and sometimes they're not deductible. I think you can agree with me, especially if you did taxation, you know that some items are deductible and some items are not deductible. So again, please go and familiarize yourself with that. So according to the information that I have, I don't have any of these things. So I don't have any non-deductible items. And thereafter, we need to go and check any increase in movement in the temporary difference. Remember when we did our statement of financial, when we did our deferred tax, we had a movement of 26,400. Remember, this movement is the temporary difference. It means this will affect the deferred tax liability. Remember, the deferred tax liability means it's going to be deductible in the future. So at the moment, we deduct it from our current tax calculation because it's going to be deductible in what? It's going to be paid in what? In the future. It's going to be due in the future. For now, we're just deferring it to the next year. So that's why an increase in the movement of temporal difference, we put it in brackets. If it was a decrease, we're supposed to what? To add it. Okay. And thereafter, we get the taxable profit of how much? Of 3,500. 700. In other words, I took the profit before tax and I deducted everything here because I had nothing to add, and I also deducted what? The movement in temporary difference, and I got this amount of money. And again, we're gonna find the current tax at 28%, meaning what did we do? We just took 3564770, multiplied it by 28%, and we got 998,136. This is the current tax that is going to be part of the South African normal tax. So in other words, under that, I'm going to have current tax, I'm going to have deferred tax, I'm going to have any over provisions or under provisions from the previous year. Any unused taxes are going to affect us there. Okay, but here we're just preparing ourselves to be able to calculate what? The note according to the requirements. From here, we need to go and now deal with the note. Here, we need to make sure that we deal with the note at the moment. Firstly, with the note, remember again, because this is just a short explanation of what is required. So obviously, we must start and say maybe the note to the financial statements of Sylvester Trader, something like that. But I left that part. So firstly, I'm gonna deal with. I'm gonna just write South African income tax. You can say SA normal tax is up to you. Firstly, I need the current tax. Which current tax? The current tax. You can see I've got 998,136 is the one that I found from the previous calculation. Remember, the current for the current year. And I must also check any over provisions because from the previous years, sometimes we find the over provisions, we're gonna minus them. If we've got under provisions from the previous year, we need to add them. And thereafter, we need to check our deferred tax. Remember, we did calculate the deferred tax from our calculation there. So we're gonna check the movements. Remember the movement in that tax there, you must come and add it here. Remember, because it was a deferred tax liability at the end of the day. So you need to copy it from the previous calculation and put it here. Please refer to the deferred tax calculation that we did. And thereafter, if you add the two, please you can check my calculation there. We get 1,005,528. And thereafter, remember that foreign tax. Remember the foreign tax was a certain amount of money, but we need to compare the foreign tax with regard to our tax rate. So at the end of the day, we had the foreign tax of 11,000. Remember, it's given there. We don't even know how much is the rate, but that's the foreign tax. So if you add them together, so you get how much? 101,652. Okay, this is the South African normal tax or income tax. Okay. Thereafter, we need to make sure that we reconcile. Okay? We need to make sure that we reconcile our tax rate. So, firstly, the tax rate reconciliation, we need the profit before tax. Remember that profit before tax, the adjusted one, it was how much? 3,785,320. And thereafter, we have to make sure that we calculate tax on that 385,320. Remember, this profit before tax is the same as the accounting profit, is the profit calculated according to the business figures, not according to the SARS. Remember, the SARS one is called taxable income, meaning we had to adjust those expenses and incomes. And then if you say 28% of 3,785,320, you get how much? 105,989. Okay? And again, you need to go and check those non-taxable items and non-deductible items. And profit on sale of land, remember the profit on sale of land, which is same as the capital profit. Remember the inclusion rate was only 80%, but that's why we had to go and took out how much? 20%. The same thing that we did under that particular calculation is still going to be done here. 187,000 times 20% is the one that I'm going to take it out to remain with only 80%. Times 28%, we get what? 10,472 in brackets. Remember, it is not taxable. That's why we put it in brackets. And we also had dividends received. They are not taxable. Again, I need to take only the tax part of it and I deduct. I must also go and find the foreign income tax. Here we need to be careful. We need to compare the tax which we paid on the foreign income and the tax according to our South African tax rate. If you remember, The tax was 11,000, but according to the South African, if we calculate according to our South African tax rate, is 28% of 88,000. We find this 88,000, we just said 77,000 plus 11,000. Remember, this is like the foreign tax before tax. So when you do that, you find a difference of what? Of 13640. You must put it in brackets because our tax, according to the South African income tax, is higher than what? The tax that we paid on the foreign tax. Okay. So we need to make sure that we minus that. Or the easiest thing is to just say 11,000 minus the answer for 88,000. You get that amount of money. And thereafter, if you take this 3,785, 320, and not this one, this is just the profit before tax. If you take this tax of 1,059 and you minus everything here, you get what? You get this amount of money. Okay. So like I said, let me just try to do this. So this one is on its own, so you don't have to add this. This is not tax, remember, it's just the amount. Let me just put lines here. So this is just an amount for profit before tax. Here you only have to add, like I said, you only have to take the current tax, you have to minus the capital profit, the dividends, and the foreign tax. Okay, can you see they've been reconciled at the end of the day? Remember, this is just a short video just to give you the basics. Remember, in the future, you can find more items. You can also have the unused tax losses. You must know how to deal with that. But I believe you can go to advanced questions. You need to study the basic questions so that you can know how to deal with this kind of question. So it is not that difficult, but you must just get your basics right. This is very much important. Especially, okay, for those who are doing third year, you know that they can text you on this, they can, not text, they can assess you on this kind of information. So for those who are doing their honors, the honors levels, those who are doing CTA, you know, so yeah, they do test. Remember, under honors, under CTAs, like they're just testing on what we've learned, even though sometimes can be very, very, very advanced. But I think the basics are very much. And hopefully this video, guys, clarified everything. And then, yes, if it works for you, I'm happy. If it doesn't work for you, I'm sorry, but I think I tried to explain. And then again, those who have been asking for this kind of things, information, I think something positive maybe. This can have a positive impact on your studies. And all the best, and I know you can do better. The only way to know accounting is to do accounting. That's what I always tell myself. The only way to do to know accounting is to do accounting. So make sure that you study hard. Nothing is easy. Make sure that you persevere. Thank you very much and have a great one. Good luck for your exams. Thank you so much.